All right, stock started off a new week with another up Monday, right? And another up post expiration Monday. So we've had two really strong expiration cycles closing pretty much at the highs of the cycle. Now starting a new one, right? And going into Santa Claus rally and all the other seasonal trends that you tend to get at the end of the year going into the beginning of a new year. So far so good. And so far so good in terms of we haven't started consolidating this parabolic move. I think the longer we can go without consolidating, the more we can just stay parabolic, right? That's parabolic moves tend to build on each other and until they run out, right? When they run out, they don't consolidate sideways. So that's the concern. It's as long as we're okay, as long as it's not midnight yet, we can still party. But once it hits midnight, whenever it does, and we don't know when it will, but we can kind of get some inklings of exhaustion and signs of weakness in terms of this parabolic nature. So we'll start to break down some of those here tonight. We've seen some last week. We'll take a look at some here today. We'll take a look at some of the sector moves and what they're showing us. Some of those sectors that did so well immediately after the FOMC on Wednesday, giving back some of those gains. So we'll talk about that and what that means, its implications there. And we'll take a look at the breadth that we've been seeing and what this big FOMC, basically the rate cut odds, which are pretty much over 60% for 6 cuts, but pretty much 100% for 4 for 2024, and the implication that has. Really, in fact, it's the big significance it has on the yield spread, which it hasn't budged on the 10-year with the 3-month, still way down 150 basis points. So we'll break all that down in today's video. We'll take a look at a trade, one of the Magnificent Seven that looks like it's set for a decent move. So we'll talk about it and how to trade it. So let's go ahead and get started. Today is Monday, December the 18th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook Live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do like this day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see another Monday to the upside. We're back on the good streak, right, of having Mondays every Monday. The last Monday after expiration was an update. The one before that was like our first down Monday in like forever that we had, or one of these was post-expiration Mondays. I believe it was that one because I think that was the one that we were traveling that Monday. It was the first Monday that we had in like weeks and weeks and weeks, months. Then we had a few stretches of some down Mondays, but I think we're back on the right track here, like 3 out of the last 4, something like that, back to the upside. The intermediate line is still above the 90th percentile, has now been above the 90th percentile for over a month. We crossed the 90th into the 90th percentile above it. On November the 9th. It's now December the 18th, so it's been a full-on month that we've been above there. That's a very, very long period of time. We've seen that in other parabolic runs, so it's not unique, but it is rare. It's uncommon. It only occurs during the most parabolic of moves that we have. The near term, the momentum line dipped to the reversal zone, so intermediate confirmation signal, and it bounced barely. Like it wasn't very much of a buy the dip, but whatever little dip there was, the market bought it, and we're up again here today. We had an opening gap that we did not fill, so we'll see if we end up filling that. Assuming that's a common gap, we'll fill that sooner rather than later. The market sentiment line's rising easily in bullish territory. It's making its way up towards the upper reversal zone. The near-term line has been since this low point here on the 6th. So that's going on 2 weeks ago. We've been on this near-term rally up to the upside after not really having very much of a near-term decline, right? We had this big move higher. We had a couple little small exhales and then now another deep inhale. So we never really have had a comparable exhale to the size of the inhale, the impulse move that we had previously. So we're just, we're kind of running out of air, so to speak. And you see that in the rate of change. When you look at the rate of change for the past, I believe it's 35 days now. Let's check that. So we're at 35. For the past 35 days, we are up over 15%, ended up 15.13%, so a little bit lower than where that line is now. If I go back 20 years, you can see again, like coming off of the COVID low, we had this move. Going into that parabolic peak, we had this move. Coming off the 2018 low point is another instance of 35 days of being right around this level. And then coming off the 2009 extreme low, and then the parabolic move here. So again, like this is not a common, like this was not a washout low point, not even like 2019. It was barely more than a 10% decline, and yet we have sparked, probably what would be the 1, 2, 3, 4, if you count these as two separate moves, fifth biggest move in 20 years, and the biggest one that we weren't coming off. I mean, this would be the smallest low point, but it's still kind of, again, coming off of a extreme bear market low. This was also slightly below the 200-week moving average, but was definitely coming off of a major low point. Even 2019, we were coming off of a pretty significant low point of comparable size. Obviously, this was not a comparable. I mean, this is about half the size. The decline was about half of what this current rally, and that's not typical for this kind of move to the upside. If I go back to the market forecast chart, the Russell 2000, which has been playing catch up over the last week, had those two clusters last week. Now you got the momentum line dipping again, bullish intermediate confirmation signal because the intermediate line is still in the reversal zone. It's actually still above the 90th percentile, and you were still over 8% in the 89th percentile of how far above the 30-day moving average we are. So still pretty extreme. We haven't filled in that gap yet. If we fill in that gap, more likely an exhaustion gap than anything, as we have hit this 200 level again, or 2000 level, on the Russell, and really unable to get through and pierce that level for the third time, right? The first time back last August, or February, the second time here this past August, July 31st, and then now, so far, now the current move. If I take a look at the Dow Jones Industrial Average, you can kind of see the strong bullish pair. This has been even more parabolic than what the S&P 500, and then the NASDAQ, which started off pretty strong, has not been as strong here lately, still shows extreme bullishness on its market forecast chart. If I take a look at the weekly chart, you can see so we talked about this in Friday's market outlook video, how we had this kind of a common exhaustion type pattern where you had a large candle after having already an extended kind of parabolic move. You've had a large candle with a large shadow. That tends to be an exhaustion type pattern. I showed you the example of of this one over here, of a large candle and a large body. You kind of see another one over here, relatively large candle. But you get these candles, and the next candle typically fills that in, but then that's it, right? Like now, because we moved up so far, that's what creates a long upper shadow. You can really see it on the Russell 2000. It was even more like this was a much bigger size. First of all, it's a much bigger size body, and then it was a huge candle. You can see an example of that over here as well. That tends to be the washout move. And here's another example over here. This was that fake out move in November 2021. We got big candle, big shadow. We filled that in with a higher Hakinyashi, but then that was it. And that's kind of my expectation of the type of pattern we're getting right now. It's a golden cross, rising PPO, but again, how likely are we for that candle to persist? If you look at the 3 green arrow chart, of course, you have 3 green arrows all across the board, as well as on the weekly chart. We are above all these major averages still, easily above the 8. We haven't been below the 8-day moving average for one day, and that was barely below it. We definitely haven't been below the 17 days. So if you look at, how far, how long we've been above the 17-day exponential moving average. It's been quite a while. And we had a pretty decent run over here where we stayed above the 17-day, except for a couple brief little touches below. And it was just very brief on both of these. Otherwise, we had a pretty decent run. The average definitely stayed above it for a pretty good time. But this is a little unique in that the average actually got higher. The moving average got higher than it did on this instance. And we've made such a tremendous move. And we had an extreme amount of volume in the last couple of days on SPY and IWM as well. Way up above. Like we were up in the highest level of the 17. And we're still in the 85th percentile, so still way up there on the Russell 2000, and your diamond's kind of showing an extreme pattern too, and has been now for quite some time, way up there, multiple black arrows in the volume on these rallies, way up above the value area. So extreme parabolic moves here. If you look at the DMI, you can see again we're almost at 50 now. We're still below 10 on the negative indicator, so another orange arrow. We're still above 40 in the positive, which so that ADX is. Remember, the ADX typically peaks well after. So we're almost at 50. Again, the highest that we've had in the last recent history goes back over here to 2018, where we had this parabolic move where we got up to. Looks like 52.93 was the highest it got there. We had a pretty decent period here, but we've exceeded that level. Obviously, we exceeded this one too on the ADX. If you look at some of the other instances in the last 20 years, there has not been another one. None of these, even coming off the bear market low, got this high. Neither did the one coming off the 2011 or any of these other instances. So. Like we are making our way. We've had more arrows now than what we did back here in 2018. Well, I guess we're kind of making our way there too. 1, 2, 3, 4, 5, 6, 7, 8. And right now I believe we're on 6. 1, 2, 3, 4, 5, 6, 7. So we're on 7 and we're almost at 50. So again, you saw, and again, an example of what happens. Parabolic moves do not let's see here. Do not consolidate sideways, right? And we saw that here again, about as parabolic then as we are now, and you saw how that one consolidated. Now I don't know, like that came out of nowhere, and we don't know what the catalyst will be this time, if there is one, right? But you can kind of see what happens once there is a catalyst for a drawdown. It tends to happen pretty quickly. If you look at the RSI and the CCI, again we are. Up above 80, so we did close above 80 for the first time in a while. We did not close above 200, so again we avoided that combination, but we are above 80, so very high on there, and you can see we're still above 100. We haven't crossed back below 100 yet. We still haven't crossed above 150. Well above 60, not quite above 70. Again, 2018 to kind of give you an idea of what this looks like, just how extreme that parabolic move was right here. Look at that weekly RSI. It was insane. If I were to show you on the daily chart what it looked like, you can see again, remember we're just above 80 right now. Well, there's that early part. We were easily above 80 for multiple days. So again, we just keep going parabolic until it's done. That nobody knows when it will done. It always lasts a lot longer than what you expect. Because there's no reason until there's a catalyst that nobody expects. Otherwise, they would already be pricing it in. So there's no reason for it to stop until that catalyst appears in whatever shape or form it ends up appearing. You take a look at the stochastics, again, still very strong. The 95th, the moving average is still around the 95th percentile. So that means the 20-day average of where we've closed relative to the 20-day range, 4-week range, is still in the 95th percentile. It has been for like multiple weeks. So very strong move from that regard. Looking at the Ichimoku cloud, very strong trend. We are above 9 now, which is an extreme high there. And you can see we're also above the 90th percentile here on the noise balance. So big move from that regard. Again, it only goes up to 100, and you can see how rare it is just to get above the 90th percentile. It's pretty darn rare. Again, going back to that 2018 level, to kind of give you a comparison for an extreme move. You can see there's the 90th, and you can see we have, like COVID, or to the decline, we got above the 95th. We were actually pretty bullish going into COVID. You can see a bullish move there. 19. There's your 18. See how extreme that move was. So we are not to that extreme, but we are about as extreme as you can be otherwise. Very, very big move. Easily above, or at least almost above the upper band, easily above the upper Keltner channel still. And the bands are still, way outside the Keltner channels. Obviously, we're not increasing in momentum. It's kind of hard to when all the lines are going up that fast at that much of an angle. We're not breaking out and expanding that volatility at all. But we'll kind of see what ends up happening here if and when we break back into the Keltner channel and break into out of this. Again, we had already been coming up. We were already parabolic before this last week's move, and now we got this kind of big washout move again to kind of show you other instances of what it looks like here when you get this kind of move. At the end of a run, you can see the COVID move. You were pretty bullish, and you got these strong rallies. There's 2018. We were pretty bullish to begin with, and then we had that strong rally there outside the bands, and then we had this one. This one's a little different because this move here is similar to the move we're getting right now, where we actually had an increase in the bandwidth on a bullish move, right? And same thing here, we had an increase in the bandwidth on a bullish move, and you can see the kind of wash out what it looks like here on this chart. If you look at the intraday range, again, we did not get a new 4-week high point. So that green line on the Arun indicator is, working its way down slowly. The range is still pretty tight, and it's going to tighten up a little bit more over the next few days. It will tighten up a little bit more. It will still be around here for quite some time. I mean, it won't get higher than this low point for multiple weeks. So I don't think the low point's a concern. It will tighten up a little bit more, probably down to this 4% range. But again, the longer we go without a new 4-week high, the more likely we are to get the crossover where the red line shoots up to 100 and the green line works its way to 0. So we'll keep our eyes on that one. Today's volume was not as large as it was last week. We dropped all the way back down below the average, 70 million, and the range also dropped below average, or stayed below average. We weren't very big to begin with. If you look at, again, the range is still right around that 4-point range. It's still easily below 1%. The volume is not as low as it's been, but it's off of its low point. The volatility index, another measure here that we keep our eye on, it closed up again today. So it's been gradually moving higher. The VVIX moved up higher again. So now you got your correlation dipping below that positive 50% again. So the VVIX is kind of foretelling about a volatility here. So we're going to keep our eyes on that one. You can see we had even bigger negative correlation here previously. We haven't filled in that gap yet. You expect at some point in time we will, because that's kind of how this works. So we'll keep our close eyes on that volatility index, as you expect. Again, sooner rather than later, once, whatever catalyst occurs to cause it, and we don't know what it might be, Powell, it might be, we don't know. But whatever catalyst occurs to start the selling, then the volatility will jump up at that point. Now let's take a look at what's driving this price action. There's a little bit of a misprint here on the dollar index. The dollar was not down 6%, but commodities were down pretty significantly. You'll see here in just a second. Of course, bonds were down. Long-term bonds were down. Bond yields were up a little bit. And then you can see the equity performance. So let's take a look. Let's look at the dollar index itself. So there's UUP, and again, a little bit of a misprint down there. If you on the ETF, if you look at DXY, that was not the case. And in fact, you can see again we had this 2-day decline last week after the FOMC meeting, and then Friday we rallied into the close, and so far holding those rallies. You can see the MACD is diverging with potentially a higher low point right now. Stochastics would also be diverging pretty significantly. We'd be holding the 62% retracement for a support level. Of course, bonds, TLT also kind of made a little bit of a decline today. Again, not very big considering the rally, but we've had such a big move up, and we're at that 200-day moving average. Of course, the question is how much further can it go up? TNX, which is not the TLT, but TNX did go up a couple basis points up to 3.95. Is extremely low right now. The MACD is way down here, about the same levels as we got over here on a much quicker move than what is taken here. But you can see like the histogram, like most of the momentum took to get to the 50-day, and then we filled into the 200-day with with the histogram being a lot smaller. So big convergence essentially there, and we'll see ultimately how that plays out. Of course, the biggest mover today was commodities, in particular commodity like DBC again, kind of getting dropped there with a little bit of a misprint. If you look at actual crude oil itself, crude oil did not really drop down very much. In fact, had a little bit of a gain coming out. It's down a little bit tonight, but yesterday had a little bit of a gain, came off of its highs. There's today's move. Ultimately closed below the 17-day moving average. The MACD is above its moving average, so at the very least, we're in convergence mode on here with the MACD and stochastics rising, even though we're not yet above the 17, haven't been above the 17 for quite a while. So you can kind of get an idea of what's driving a lot of this. I did want to take a look at the skew. So the skew in the last few days has really skyrocketed. It got up to 162 a couple of days ago. It still stayed at 153 today. It was at 152, I believe, the day before that. You can see the MACD for the skew is really kind of skyrocketed as well. Again, the options market here, again, volatility is not very high. It's very low, but that's not the only measure of safety, of risk aversion. The skew is another measure of risk aversion. And again, more not necessarily for short-term risks, as in like tomorrow, because that's what the VIX measures, but it's more of kind of fat tail risk. Like there's a big risk that we won't just pull back a little bit, right? Like a little tiny pullback here, like these. It'll be more of a bigger decline, like we saw over here when the market was pricing that in 2021, going into the correction of 2022. So. And we also had a big jump in this volatility, in this skew over here right before the pullback, this 10% decline here. Remember, that was a correction for the Russell 2000. So again, very, very high levels, very short-term spike, move up to these high levels. Of course, from a breadth standpoint, we're already very extreme. We're above 400 again on the 20-day average. That's not the highest it's been in the last few years. If you look at the last few years here, you can see in November we got up to above 400. Over here in August we also got above 400 on the average, and of course in 2021 when things were going haywire, we really got high from a breadth standpoint. But needless to say, here we are again. 1, 2, 3, 4 times that we've hit, 4 times that we've hit these peaks of at least 450, maybe right around 450 on the actual number of stocks above the 50-day. And then all 4 of the instances, the average got above 400. And again, once we get below the average is when you start to see some weakness. Speaking of getting below the average, the new highs and new lows last week spiked up to almost 800, 767 on December the 14th. And then we dropped sharply, and you can notice already we're back below the average, right? So the average jumped up to about 100 some odd, but today's new highs, new lows index dropped all the way back down below 100, just like that. So back below 100, back below that average. Now it's not negative, but it kind of gives you an idea of, again, just how much of an exhaustion move we had last, where the skew spiked and this spiked, and like I said, the breadth is moving up higher. In fact, when you look at like the McClellan oscillator, you can see the breadth had jumped up again, kind of one last hurrah up to above 70 before now falling already back below 30, and we'll see if it ultimately turns out to be anything more than that. And then finally the money flow. Let's look at the money flow. Here it has jumped up to higher highs, very significantly higher highs, higher than what we saw over here, though we're not getting higher highs on the actual money flow index, which is kind of an oscillator version of the summation index that you get here. And just remember too, we have to go back. We're right now at levels that we haven't seen since pretty much over here. And if you look at over here where the volume was compared to now, again, we are way behind, way behind in the money flow. And so we're, it's after an extreme move earlier on this particular intermediate run, and then now getting higher highs with the index is getting obviously lower highs. It's a pretty significant divergence showing up there as well on the money flow. So needless to say, we're in a parabolic move, but also needless to say that we're not there's signs of exhaustion in this parabolic move, and it's just a matter of when, right? When whatever catalyst it is, that doesn't matter. It's just a matter of when that catalyst appears that prompts the type of move we've seen in past parabolic moves once those peaks hit. So it could be this week, it could be next week, it could be after the holidays, it could be in February. We don't know. As you saw in 2018, we just kept going parabolic for a long time to extreme levels. That was like the parabolic move of all parabolic moves. And as you can see right now, we're kind of catching up to that pretty quickly. That doesn't necessarily mean that today's the peak or tomorrow's the peak. But as we saw in 2018, as well as COVID, because that was a parabolic peak here, pre-COVID as well, and other moves, even last August, you can kind of see what happens once they do start to consolidate. Let's take a look at how the sectors performed today. So hopefully there's no bad prints on that one. Doesn't look like there is. If you go to December 18th and just look at today here, you can see XLK, XLY, XLC were kind of your bigger movers, XLP also. But really, there's only one sector that outperformed the markets, and it doubled the markets, 0.5% versus 1% XLC. Utilities and real estate not doing so well at all. So even though there's small gains in yields, but they had rebounded to a small degree. They didn't really take off. But they had rebounded. They had been such underperformers, and they took off here post-FOMC. They're giving back all of those post-FOMC gains. Not real estate. Real estate hasn't given it all back. But utilities and staples has given all those post-FOMC gains back. They're gone now. And you can see XLK, XLY, XLC outperforming because it's been a laggard. It's trying to catch up. All your cyclical areas doing pretty well. And again, you have to go back to the last peak here. When things really started to drop in the 1st of August, those are the areas that are past that peak, including XLC, XLY, XLK, financials and real estate up there too. Not two sectors you typically don't see together. And then, of course, energy lagging along with staples and utilities are still down 6% from that peak. In fact, when you look at the 12 grid for all the major sectors out there, you can see clusters forming all over the place. Dark green shading and green line, pretty decent numbers. 13% for XLK, 6 to 7% here, 9% on real estate thanks to that big move. But then clusters on real estate and utilities there, and you can see healthcare and staples also had a big move. Or again, like I said, all of them giving it back, right? They're all utilities giving back. Real estate's really the only one that hasn't given it all back. And everything else, materials forming a cluster and starting to give some of that back, and energy getting you 3 red arrows and looking like it's so far going to hold as a reversal and not necessarily, a continuation pattern, not necessarily a reversal pattern. All right, if you take a look at our trade idea today, I want to take a look at NVIDIA, which is approaching $500 again, a big round number for NVIDIA. It kind of reminds me of the big round number for $1,000, I believe it was, for Qualcomm back in the day. But NVIDIA is at 500, a little bit of a ascending triangle here, cup and handle, whatever you want to call that. Intermediate line crossing back above the 80th percentile. It's still above its market sentiment. Market sentiment still has some room to run. And you got dark green shading, the green line. You can see the weekly chart looking relatively bullish. Obviously, the PPO had been dropping. It's still at a pretty high level. But it has been dropping. Now you got it back to a bullish candle. Looking at the 3 green arrows, obviously you have 3 green arrows on NVIDIA. It has for a few days now, so we're set from that perspective. And when you break those lines apart, you can see the We hit the 50-day moving average for support. We bounced off of that. The 8 and 17 are back to crossing above the 30. The MACD is rising above its moving average. Stochastic's rising above its moving average. The DMI looks positive, crossing above. We're not extreme like we were. We're not extreme now. Not like the markets either. The RSI and CCI are breaking out to new levels. If you look at the weekly CCI, you can see we had crossed above 100 previously. We're still above 100 there. Looking at the Ichimoku cloud, we are above the cloud. Nice above the cloud. Positive rate of change. We're just starting a new weak bullish trend. And if you look at the Bollinger Bands and the Keltner channels, we are pushing up against that upper band in the 95th percentile. You can see we had enough of a pullback to get the red dots here on the momentum chart. We've been negative, and now we're, you would expect we'll turn positive here, and eventually the bands were really close, already breaking outside of the Keltner channels, which will turn the dots green, which would mean we're in a new trending move. But again, considering the nature of the market, I decided to look at the to do a long call vertical spread, and I went at which was at the time the at-the-money contract. I bought the 502.5, sold the 505. You can see it ends up giving me about a 1-to-1 reward to risk ratio. The stock is down a little bit since we got into it, but I've got very, very low risk, half of my normal risk, and I'm going for a little bit more than I normally try to get on a high probability trade. And you can see how much flexibility I have. So this is a relatively decently high probability directional trade, hence the 1-to-1 reward to risk ratio there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.